Hi, everyone. I'm Adam Thurgood, Managing Partner of Hightower Las Vegas, and I'm joined by Raina Penalova, our Director of Research. And we're pleased to be with you today to go over our Q1 client briefing, which we've titled Crosscurrents. There's a lot going on in the macroeconomic world, and we're going to get into the nitty-gritty of it today. So Raina's going to kick us off, and I'll come in for the middle section, and she will finish off our thoughts. So with that, Raina, take it away.
Thanks, Adam. Hi, everyone. Indeed, we're starting off 2023 in a very unique situation, right on the back of some very aggressive rate hiking in 2022. On this first chart, we've plotted the last 5 rate hiking cycles. On the bottom, we have the duration, or how many months it took from start to finish. And on the right side, we have the magnitude, or how much interest rates increased in that time. And with the orange line, we can see the current hiking cycle that started last year. It has been less than 12 months, and we've already gone up 4.5% in rates. And that draws a very stark contrast, especially to the last hiking cycle that started in 2015 and ended in 2019. It took 36 months for us to increase interest rates by just 2%. So a different tone from the Fed, and for a very good reason, I would say. Inflation absolutely skyrocketed in 2021, perhaps because of excess monetary stimulus, also mixed in with some supply chain problems. But producer price index, for example, here in gray, had a high of 18.3% in June of last year. Currently, it sits at 9%, a welcome deceleration, but still far away from the Fed target of 2%. And then the Fed's preferred measure, core PCE, or core personal consumption expenditure, currently sits at 4.4%, again, well above the target of 2% and also above its long-term average of 3.4%, which includes highly inflationary periods of 70s and 80s. So as we know, monetary policy works with long and variable lags. So it's possible the Fed has already done enough to combat inflation. And we have different opinions from different markets on that front. So, for example, from the bond market, we have an indicator that has to do with the Fed funds rate and 2-year treasuries. So when 2-year treasuries cross below the Fed funds rate, which is the one that the Fed sets, and it's indicated here in green on the charts, we see that usually indicates the Fed is done or close to done increasing rates. We can also see that that's also associated with recessions usually, which are marked in the red or orange bars on the chart. And currently, we are in that situation. We are currently in 2-year interest rates are 65 basis points below Fed funds rate, which is pretty significant and not to be ignored. So there's 2 different reasons why that could be the case. First, bond markets could be saying that Fed is doing enough and inflation is simply going away, and stock markets seem to be agreeing so far this year. We've been off to a very good start. NASDAQ is up about 15% since the start of the year so far. The S&P is up about 8%, and Dow is lagging, but still up 3% since the start of the year. So stock markets seem to be indicating we are going to have a soft landing. Perhaps growth is going to rebound from here, and the Fed doesn't have a reason to be hawkish anymore. So are we off to the races from here? Should we just pile on risk? Well, let's look at leading indicators and not jump to conclusions too soon. And spoiler alert here, they're not looking too rosy. So first, we're going to look at the yield curve. So usually when we talk about yield curve, we compare the 10-year to 2-year interest rates, and that's often criticized in the media for forecasting 8 of the last 3 recessions, or in other words, having a lot of false positives there. But on the contrary, this lesser known metric of the yield curve, the 10-year rate versus the 3-month rate, inverts a lot less frequently. But when it does, it's a lot more reliable indicator of future recessions. This chart goes back to the 1960s and it's never had a false positive. And currently, we sit at negative 100 basis points. So 3-month interest rates are higher than 10-year rates by 100 basis points. This is a signal, again, from the bond market that future growth is to be expected. Another reliable indicator, a leading indicator of manufacturing and growth is the ISM Manufacturing New Orders indicator. So anything below 50 signals contraction or slowing activity. And in the past, levels below 47 have been associated with recessions. Currently, we're at 42.5. Once again, not very good looking when we're looking ahead. And then even if we just look at a broad measure of leading indicators, the leading indicator index, which combines 10 different indicators, the year-over-year measure of that is again decelerating at 6% rate. So we have some different opinions there from markets, from leading indicators, but again, we know that home prices, the housing market has a very high importance for the economy, has a very high multiplier, and Adam is going to dive into that one next.
Yeah, housing not only has a big impact directly from the labor and the materials that are used to build homes, but when we buy new homes, we buy new furniture, we buy decorations, we buy appliances, and so on and so forth. And that secondary impact also is a pretty big influence on the overall economy. Now, when we look at the home builder sentiment index, it's absolutely plunged over the last 12 to 15 months. This is not exactly a great forward sign because home building activity tends to be one of the longest leading indicators, has a 15 to 18 month lead on actual economic activity. And we're getting to about that 15-month point. And it's no wonder that home builder sentiment is down, because when we look at the cost for most people to buy a new home, the average principal and interest payment has almost doubled over just the past couple of years. We're now sitting at about $2,000 for the average principal and interest payment. So when you look at that in affordability terms, we're down to levels that we haven't seen since the housing crisis. Now, we're a long ways away from a housing-led crisis, simply because a lot of that damage has been repaired. There's a lot more equity in homes today, and a lot of this decline is just burning off some of the excess that was built up in the pre-COVID or in the post-COVID era when demand for homes just absolutely skyrocketed. But if we take the leading indicators that Raina laid out, we pair that with housing, and we take a view of the economy, it doesn't look all that rosy. But on a coincident basis, what's happening now with the indicators that are more real time of current economic activity, there's a mixed bag. Certainly when we look at something like industrial production, it's rolling over a bit, but it's far from dramatically negative or deeply recessionary. And production is a big part of the economy. This is the manufacturing purchasing managers index. When it's below 50, it's contracting. So we are in that contraction mode with manufacturing, but we're really more of a services economy. And as services are only slightly dipped below 50 and are back into that mid 50s range, this is suggesting that the economy, a large part of the economy, is going to be just fine. Now, it is quite volatile, so we're going to keep a close eye on what this does because we want to make sure that services don't roll over. If services roll over, then we're almost certainly going to go into a recession. Now, we are seeing banks behave as if we are in recession. This is a chart showing the percentage of banks tightening lending standards. And when we see a move like we've seen over the past year or so, it typically coincides with some sort of a pullback in economic activity, if not a recession. And the one time that we saw a soft landing actually work was in the mid-90s when the Fed was trying to engineer a soft landing. And at that point in time, where you can see this blue circle, banks were not tightening lending standards like they are today. So we think that the ability of the Fed to navigate and actually create a soft landing is challenging when banks are behaving as if a recession is already happening. Financial stress really isn't too big of a deal. This is something that we keep an eye on to see how markets are behaving. Certainly not at levels that we saw in 2008 or even during the COVID boom, COVID bust, I should say. So financial stress is not much of a concern at this point. And of course, the labor market remains extremely strong. It is more of a lagging indicator, but we're not seeing tremendous job loss or deceleration here. In fact, we had a really robust non-farm payrolls report last month. And the reason that the payrolls data and the labor data remain so strong is because we still have a lot of open jobs per unemployed person. We have about 1.9 open jobs per person that's unemployed. And until this metric comes down, it's going to be really hard to see mass layoffs throughout the economy. Now, we are starting to see some cracks in the labor market. For instance, year-over-year job openings are now negative. But if we take that, in perspective, we saw this massive boom in job openings coming out of COVID, and now we've just basically worked that off. But one interesting component is manufacturing overtime hours have started to decline at a fairly decent pace. And this typically occurs when we are in a recession. So a lot to keep our eyes on here, and especially across to the other side of the globe with China. China is the second largest economy in the world, and they've been locked down for 3 years, and suddenly they're reopening at an aggressive pace. And so we would expect the same type of things that happened in the developed world to happen in China. Big increases in demand, more stimulus that filters through the economy. And when we look at what's happening in China and the potential impacts of its reopening, it could be quite beneficial for China's economy and other parts of the world that are dependent on China, but also it could cause some inflationary pressures. We're seeing industrial metals prices increase fairly rapidly. That would suggest that there's going to be a commodity demand boost coming out of China. Consumption demand should be up in China. We're already seeing it in flight data. The number of flights in the Chinese economy has absolutely surged in the past couple of weeks. And of course, China is such a big economy that if it has a positive growth impulse, that should work its way into the global economy, especially for countries that are integrated with China's economy, like in Asia and even Europe is a big block that does a lot of business with China. And we're seeing the dollar weaken, which typically is a sign of better global growth. So it's really interesting to keep an eye on what's happening with China's reopening, because it could have a bunch of different effects that could be positive or negative for what we're having to deal with in the US. Certainly, we want the supply chain issues resolved so that we have less inflationary pressures. But if China's reopening also causes commodity prices to surge higher, then that's going to cause inflationary pressures. So we're dealing with this weird cross current of forces where you have the big developed markets of the world slowing down and potentially facing recession in the coming months, coupled with the second largest economy of the world coming out of a 3-year lockdown where we expect their growth to increase fairly dramatically. And this causes a lot of tricky analysis for portfolios. So Raina is going to get into some of the things that we're seeing in asset markets and how we're positioning portfolios.
Yeah, indeed. Investors are facing quite the cross currents right now, with Fed trying to fight inflation and solve that problem for good, and at the same time, China boosting global growth and possibly complicating that for the Fed. So what does that mean for asset classes? We have some very interesting dynamics going on. Firstly, with gold versus the S&P. This is the chart of gold and the S&P since the last bottom of the S&P in October. It's very unusual for gold to perform well in that situation, and it's performed pretty much as well as stocks since the last bottom. So there's a few different reasons why gold would be doing well right now. First, we have record central bank buying, and it's that could be for a variety of reasons, but probably also related to sanctions. As we know, when Russia started that war in Ukraine, there were quite unusual sanctions implemented against Russia. Effectively, their foreign reserves were confiscated by other central banks. So it's to be expected that central banks around the world are taking note and possibly diversifying their foreign reserves with some gold, for example. We also have some interest rate uncertainty. Emerging markets are reopening, as Adam just talked about, and China and India tend to be the largest consumer buyers of precious metals in the form of jewelry, usually. And then we also have rates possibly plateauing as we are nearing the end of hiking cycles, which tends to be good for gold prices in the future. So speaking of rates, we have some pretty interesting dynamics going on in the background related to the debt ceiling debates. That's brewing up to be quite the fight in DC and possibly to continue on for until the end of the summer. So quite a bit of the sausage making going on there. But in the meantime, that has important implications for the Treasury. They are forced to conduct emergency measures, which means they need to be drawing down on the Treasury general account, which is essentially their checking account. Currently, they have about $500 billion sitting there, and they are starting to draw on it and possibly drawing all of it over the next few months, which tends to add liquidity to the system and effectively offsetting what the Fed is doing with quantitative tightening for the next few months. But it's interesting to note that once the debt ceiling debate is resolved, and we think it will be resolved ultimately, we're not going to default. The debt ceiling is probably going to be raised. But at that point, the Treasury is going to draw on liquidity to replenish the Treasury general account once again. So that's something that's always going on in the background and is important for funding markets and from their credit and bond markets as well. And we shouldn't lose sight of the fact that we've done a lot already, and interest rates are compelling right now. Just putting some dry powder on the side, parking it at some one-year treasuries would yield you between 4.5% to 5% right now. So it gives you a pretty good it's a pretty good argument to just not take excessive risks at the moment. And when it comes to using some of that dry powder, with regards to stock market, we think that the value right now is in international markets. The S&P PE ratio, which is the price to earnings ratio, it's a way for us to determine the value of a stock or a stock index. Right now sits at 19.5 times earnings. That's high compared to its long-term average. And it's also high compared to international markets. As we see, they offer a lot more value at the moment. And as Adam talked about earlier, they could also benefit from China reopening more than the US would, given the trade disputes that are going on at the moment. So what are the strategy implications? Putting all of this together, there's three major takeaways and themes that we're implementing throughout portfolios right now. First, we think that gold is likely to outperform bonds, which are likely to outperform stocks in the next year. When it comes to stocks, we think the value is in international stocks, given how much the dollar has also risen over the last year. If that comes down, it would benefit international stocks even more. And then we also think that given how high interest rates are at the moment, it makes sense to have some dry powder. We've been raising cash and keeping it in some short-term treasuries and waiting for the right time to deploy that cash. And as Bruce Lee said, patience is not passive. On the contrary, it's concentrated strength. So we think it makes sense to keep some concentrated strength in short-term treasuries and being paid to do so right now, and waiting for the right time to deploy that. So thank you for your time. As always, feel free to reach out with any questions, and we'll see you here next time.